Hello, I'm Badani Ariyam. In this video, I'm going to look at how to manage the cash flow. Cash flow management. Cash flow forecast deals with the transactions at the time of payments and receipts. If a sale is taking place, that does not mean cash flow will get affected, as it could be a credit sale. You might make a credit sale in a month. That depends on your credit agreements with your customer, and you might receive the money after 3 months. So you cannot include that amount that you have sold, that amount, in that particular month's cash flow. It has to be in the month you receive the actual payments from the customer. That is essential to do like that. This also helps. Once you prepare a budget, depending on your profit and loss account, it is essential to ensure you review the cash flow to see the financial situation and also the business is possible. That's important. Cash flow forecast. A cash flow forecast is the flow and movements of cash into the business. A lender will insist on seeing a well-prepared cash flow forecast. Most of the banks, they offer cash flow formats to the people who are not familiar with the cash flow forecast. It helps to make sure you receive the cash flow for the sales in a particular month matches with the budgeted figure. It enables you to see the more details of the flow of money to make plans. And depending on your business, might be able to produce a cash flow forecast for a more extended period. But the thing is, because if you are making too many credit sales and it is in a month, maybe at the end of the month you have done so many sales, you can create an extended period's cash flow. But that's the question is the accuracy would be you might not have an accurate cash flow forecast. Constructing a cash flow forecast, an average yearly cash flow consists of date, receipts, expenses, closing balance and opening balance. The closing balance in a particular period of a cash flow forecast is the opening balance of the cash flow forecast for the next period, the following period. The income in your cash flow could include the following: cash sales, debtors, other income. Cash sales, it is the amount of cash you receive when you sell a product or service. In retail business, where only cash sales are there, it is easy to create a cash flow forecast if the budget appropriately done. For example, if the budgeted sales for a month is $25,000, so the cash flow forecast should say the same amount because there is no credit sales involved. Otherwise, if you have not made that to $25,000 in a particular month, you are facing a deficit budget. Debtors, it is a credit sale that customer pays within a particular period, within a specified period, but that should be within the cash flow period as well. If not, you cannot include that as your debtors in your present cash flow forecast because you will receive the payments after the period. So that depends on your credit agreement with the customers, but some might not keep the date of payment. You have to make sure that you know about that as well. Therefore, it is essential that you monitor your cash flow on a monthly basis to make it accurate. Other income, here again, depends on the type of business you do, because you might have unexpected income during your cash flow forecast period. For example, if you are registered for VAT, you might get a refund from the previous period in a particular month. So that has to be included in the cash flow. Maybe some income from other investments that you have made for your company. In this way, you cannot ignore the fact you might receive unexpected income for a particular month. So this should have been forecasted and included in your cash flow and the budget as well. I hope you liked this video. I hope you understood how you manage your cash flow for your business. Thank you for watching my video. If you like it, please share it. Thank you. Bye for now. I'll talk soon.